Good morning, everyone. You are watching the live market outlook for Wednesday, 1st of February 2012, beginning of a new month. Also, this weekend of this week will give us the key event of every month, U.S. non-farm payrolls that are due on coming Friday, with today's ADP non-farm employment change expected to be the first indicator. More of this we'll see in our view of today's events. Past 24 hours action shows the euro coming under heavy pressure again and losing some important supports, while sterling also failed yesterday after testing the very strong resistance zone at 157.70, 158, failed to break higher, and the subsequent pullback is now seen as a corrective if we keep above certain levels that we will see on our technical part. Dollar is at the weakest, lowest points against Japanese yen, as the Japanese currency is further strengthening, and the increasing risk of Bank of Japan's action to prevent further strengthening of the currency, as the last time and the end of October, dollar yen hit record low at 75.56 when the Japanese central bank acted and intervened, pushing the pair significantly higher. The dollar is recovering against Swiss franc. However, for now this is seen as corrective, while gold holds steady of recent highs at close to 1750 zone, with the crude oil still being under pressure, but moving sideways in the short period of time. Stocks also were pressured about growth worries, with today's focus on PMIs that are due from UK and the Eurozone, also from US, and this is the focus today on today's events, along with the ADP non-farm employment release that is, I would say, key for the dollar, and would be the indicator for the non-farm payrolls due on Friday. As said, the dollar hovered at 3 months low against the yen, and looked poised to lose ground for a fifth straight day, as the pressure by the Federal Reserve's pledge last week to keep interest rates at the extreme lows until at least late 2014 keeps the pressure at greenback. The U.S. the Fed's decision actually has triggered the broad selling in the dollar battered yields on U.S. Treasury notes, with the yield on 5-year note barely above levels not seen since at least 1960s. The dollar revisited 76.10 level on yen, last time seen 3 months ago, and pushed lower by selling from Japanese exporters and model funds, although bargain hunting by Tokyo margin players so far is offering support and keeping the pair above 76. More analysts now believe that Fed is paving a way for another round of quantitative easing, which will encourage the use of the dollar as the funding currency for carry trades. The dollar recent weakness has kept traders on their toes, as the greenback is now within shouting distance of its record low against yen, posted on 31st of October, as I mentioned, when the Tokyo stepped into the market with the massive yen selling intervention. As said, euro remains under pressure, as still no results from Greece, but hints from Greek Prime Minister yesterday that they are close to make a deal with their private bondholders. Has already been digested, and the pair stays under pressure for now. As I mentioned, losing some important support levels and heading south in past and from yesterday's midday until now, and hitting levels close to 130 for now. Brief look on today's calendar that is quite full, apart from indicators released overnight, where Chinese manufacturing PMI showed a better than expected release at 50.5 compared to 49.8 today's forecast, and 50.3 previous release. Average cash earnings from Japan came in the slightly better than expected, minus 0.2% is today's release compared to minus 0.3% of today's consensus. Chinese final manufacturing PMI came at 48.8 compared to 48.7 previous month release. Still to come, retail sales from actually they are, I think, released now. Retail sales from Swiss yearly release 1.6 is today's forecast compared to 1.8% previous month release. Swiss PMI due at 8:30 GMT. Positive forecast 51.7 compared to 50.7 previous release. Eurozone final manufacturing PMI is due at 9 o'clock, and no changes expected. 48.7 today's forecast compared to 48.7 previous release. UK's manufacturing PMI is due at 9:30 GMT, and 50.1 is the consensus for today compared to 49.6 of the previous month. Eurozone CPI flash estimate due at 10 o'clock, 2.7% today's forecast compared to 2.8 previous month release. From US ADP non-farm employment is due at 13:15 GMT, and drop to 189,000 new jobs is forecasted for today compared to significantly better release of the previous month of 325,000. This might indicate also that U.S. non-farm payrolls due on Friday might come in a lower than previous level. U.S. manufacturing PMI is due at 1500 GMT, and 54.6 is consensus for today compared to 53.9 of the previous month. At the same time, U.S. construction spending slightly more negative than the previous release of 1.2%. Today's consensus 0.7%. At 15:30 GMT are U.S. weekly crude inventories with build of 3.2 million barrels forecasted for today compared to last week's a build of 3.6 million barrels. That would be all from for today's events. Now let's see the latest action in the markets and see how the currencies and commodities moved in past 24 hours from our last session. As we can see, the euro, after hitting 132.32 high on 27th of January last Friday, renewed attempt higher, stalled short of this level at 132.12, and subsequent weakness through main bull trend line at 131, and a strong support higher platform at 130.75. Also 50% Fibonacci retracement of 129.30 to 131.32 has further weakened the structure. Short recovery and just brief recovery followed after yesterday's dip to 130.40. This is the low of yesterday, with subsequent weakness briefly breaking below this level to 130.25. And still with negative near-term studies threatening further extension lower towards 130, and possible extension to the very strong support at 129.30 low of 25th of January. Current bounce on oversold hourly conditions is heading towards initial barrier at 130.90. This is the high of today, overnight's high. Before this at 130.75.80 you have the previous strong support, now reverted to the resistance, and this makes the quite strong barrier for the single currency. Would break here to avoid immediate risk at the downside and allow for stronger recovery. However, a regain of a minimum 131.30 where the 20 days moving average currently stands, and also there is it's a broken bull trend line drawn of 126.22 low, is required to ease the current bear pressure and attract levels above this at 132.00, possibly to test 132.12 and 132.32. Significant is the completion of the head and shoulders pattern on the seen on hourly and also on 4-hour chart with the neckline at 130.75. Broken, that might signal as a break of the below the head and shoulders signal is quite break below the head and shoulders pattern is quite bearish signal, and might trigger further extension lower. The British pound is also in the near-term corrective mode after testing the very strong support at 157.70. December's range ceiling also close to it, 158.05 is 61.8 Fibonacci retracement of the down move from 160.164 to 152.33 low of 13th of January. Current easing lost the first strong support at 157.40. So far we saw 157.05 just ahead of psychological and figure support at 157.00, and close to it is the main bull trend line at 156.87, loss of which would further weaken the structure and open for the next strong support zone at 156.85, 156.65 and 156.40. This is the consolidation range floor below which would signal would delay the short-term uptrend in favor of stronger correction. Holding above 157 and 156.87 currently, the bull trend line keeps the structure still positive, as the 20 days moving average on the 4-hour chart so far contained dips. There was a brief break below, but the price action quickly recovered higher, so we might see the fresh attempt higher as a strong bull trend from 13th of January's low at 152.33 stays intact for now and sees scope for a further extension higher. In addition, the quite positive daily structure is setting scope for a further extension higher with the break of this very strong barrier at 157.70, 158 required to open way towards 157.58, 87 previous high of 18th of November, and 59.00 is feeder resistance ahead of dynamic barrier 200 days moving average. Our key barrier currently standing at 159.53. For now, 90 days moving average on the daily chart holds the downside protected, and currently standing at 156.67. This is also the strong support zone mentioned earlier around here. So holding above this area will keep the focus at the upside, and look for a retest of important barriers 57.70, 158.00, and further extension higher. Dollar yen, extremely negative outlook in the short term after upside failure to clear the very strong barrier at 78.20.30 zone, where is also 200 days moving average, resulted in a sharp reversal, loss of 76.50 hour key medium term support, resulted in the further extension lower. So far we saw 76.10 low. Currently the pair is moving within very narrow range, just holding just above 76 as our initial support on the downside, with the 20 days moving average on the hourly chart maintaining the pressure towards the downside. Loss of 76.00 to open way for a test of the all-time low of dollar yen at 75.56, possibly break lower to result in posting fresh record lows, unless Bank of Japan acts at this point. Most likely they are looking for a clear break below 76 and then to take an action. Still no firm confirmation, but this is quite likely that some action will be seen from the Bank of Japan, as they intervened the same, approximately the same levels last time in the end of October. However, they appear, after initial attempts to hold these gains, failed to do so, and returned back to the previous lows. Dollar Swiss near-term price action shows the pair in the corrective mode after yesterday's dip found ground just above previous low at 91.13. Footstep was found at 91.20, and subsequent strong rally cleared our initial strong barriers at 92.08 and 93.38. Also 50% Fibonacci retracement of the down move from 93.38 down to 91.13. That was the latest leg lower. Positive structure is now seen supportive for a further extension higher, as some key barriers were cleared. A corrective reversal on overbought hourly studies should find support around and above 92 zone to maintain immediate positive structure, with the 20 days moving average dynamic support currently at 92.05, still pointing higher and underpinning the latest bounce. Loss of 92, 91.90 would delay and risk return back to the levels of 91 zone with the previous lows. A wider picture outlook is still quite negative, with the current bounce higher seen just as a correction of the broader short-term downtrend from 95.73. However, regain of 90 days moving average might give additional support and look for further correction higher. On the upside, 93.38 offers a strong barrier along with the 55 days moving average, and is expected to cap the upside for now, as the daily studies are still in the negative territory. A brief look on the currencies. Daily outlook for gold still remains positive, as the yellow metal ends the month of January with its biggest monthly rise since August last year, and the investors are still awaiting more data from the world's key economies for further trading decisions. The positive structure of 15.22, 29th of December 2011 low keeps the gold price well supported after break of main bear trendline drawn of 1920 and the 55-90 days moving averages. Before this, there was a break above 200 days moving average, extending gains towards initial strong barriers 1756 and 1763. Also 1767 is the 61.8 Fibonacci retracement of 1920 to 1522, above which opens 1800 zone as previous highs and the psychological barrier. As said, positive structure on the wider picture is still intact. However, it's the prices are entering overbought territory, and some corrective action might be seen ahead of further raise. On the downside, holding initial support at 1700 and holding above 16 1670, 1660, 70 zone approximately. Here it would still keep the bullish structure intact. On the short term, 20 days moving average on 4-hour chart so far contains dips as the gold price in past 2 days moving within a narrow range just of the fresh highs. The crude oil, as we can see, it's still holding the sideways mode in past couple of days after hitting a low at 97.43, but upside remains capped at 101.37 as yesterday's strong rally hit levels just below this, but subsequent sharp reversal keeps the price action within the current range. Rather neutral short-term studies are not showing any direction for the time being, with the break of either side to define the short-term direction of the crude oil price. For now, the trend line resistance 101.22.37 offer initial resistance ahead of 101.73, which is the main bear trend line, and break of which is going to confirm the upside direction, while loss of initial support yesterday's low at 97.85 to open key support at 97.43, and likely to trigger further weakness and further reversal after the oil price hit the fresh high at 103.72 on the 5th of January 2012.